So yeah, we have Nate Hare here with Directed IRA. He's gonna cover a little bit about everything with the self-directed IRA. He's with Directed IRA, which is the custodian that I house my account with as well. I believe they're based out of Phoenix. Is that right?
Correct.
Right. Okay. Phoenix. I knew it was Arizona, but I wasn't sure what city. So yeah, they're based out of Phoenix, and he's gonna go over a lot of things as you can see on the screen. In the next 40 minutes, he's gonna go over all that. So sit back, relax, hold your questions to the end, and look forward to learning them. So I'll turn it over to you. Thanks, man.
Thanks, guys. Thanks for having me, Antonio. Thanks for spending some time with us, guys. I'm gonna really talk about retirement accounts and how they can be invested in real estate, but it's probably, if you haven't heard how to do this, it might be eye-opening for you to hear about how you can use retirement accounts, small retirement accounts, large retirement accounts, other people's retirement accounts, and use it as a way to buy and sell real estate. The reason I'm passionate about teaching this is because I never learned this in school. Nobody ever taught this to me. I happened on it by chance because I was recruited by a self-directed IRA company out of Houston, Texas. Is where I started my kind of career in self-directed IRAs. And it blew my mind that more people should understand how they can really utilize retirement accounts to buy and sell things that are not tied to Wall Street. So I'm going to talk a little bit about that. I've only got about 40 minutes to share with you guys. So this is really just kind of the tip of the iceberg. There's so much that you can learn and understand about self-directed IRAs, and we've got a ton of education that we do that's free to anybody, whether you're a client or not. We just did a workshop this morning, had about 200 people on it, talk about small IRA strategies. You're always free to watch that stuff or join in on this, but this is just going to be just for you guys, just to understand how a self-directed retirement account works, why you would even want to own real estate inside a retirement account versus owning stocks and bonds and mutual funds, which is what most people buy and own. The 7 different plans that you can self-direct. That's very important because these plans have better tax benefits than me or anybody on this work or webinar as individuals. We're tax-paying individuals. IRAs and 401ks are not taxpayers. If you can understand how to invest more consistently in those types of accounts, essentially what you're doing is you're getting Uncle Sam out of the picture when it comes to rental income, capital gains, and all the income they like to tax. They can tax you, but a lot of times they cannot tax your IRA. So I'm going to talk a little bit about how to use that. I'm going to talk a little about some creative strategies too, because a lot of people have a misconception that you have to have some enormous IRA or 401k to buy and sell real estate. You don't at all. I've seen self-directed IRAs start with as little as $10 in the account and turn into hundreds of thousands of dollars just by the creative strategy they use for their IRA to acquire property. So I'll kind of save that to the end, but just stick with me here. We're going to build on it as we go. Just a disclaimer, directed IRA is we're considered a passive IRA custodian. Okay, it's a little bit different than your traditional custodians like a Fidelity or Charles Schwab, where Fidelities and Charles Schwab's they sell investments. They're licensed securities brokers. They're in the business of selling investments. It doesn't make them bad guys. We're not in the business to sell investments. We do offer the same type of retirement plans as Fidelity or Charles Schwab, but in our account agreement, it says you get to pick the investments, but we'll still act as your custodian. And we have no investments to sell you. Okay. So it's a little bit more of an entrepreneurial way to invest your retirement, knowing that we don't have investments that we're going to limit you to, but the spectrum of investment becomes much larger when we let you invest in anything the IRS allows. But in that same token, we can't give you tax, legal, or investment advice. We're only giving you good education so that you can be a good self-directed IRA investor and you can understand how to properly use these self-directed IRAs going forward. So I'm not giving you guys investment advice. I'm just giving you guys good education so you can get your wheels turning and hopefully that you become a client of ours at some point. And if you want to invest in real estate, fine. If you want to invest in other things, I'll tell you how to do that as well. Just a little background about myself. I've been in the self-directed IRA industry for over 10 years. I do have the designation of a CISP, which is just a nerdy term, meaning I passed the exam given by the American Bankers Association. I know a lot about IRAs and 401ks, not just self-directed IRAs. But my career actually started in real estate. So I started back in 2002 working in the mortgage business. I was very successful in the mortgage business. I started buying and selling my own real estate. And it wasn't until 2012 that I learned that I can use IRAs and 401ks to invest in real estate and invest in notes, which is actually what I do in my self-directed account. I do hard money lending out of my Roth IRA. I'm not going to get too off in the weeds in that, but it blew my mind that I didn't know that I could use my knowledge as an investor to help my retirement grow. I thought that I just had to open an account and let somebody else invest it for me. That was my misconception about how retirement worked. Okay. So I do have a lot of experience in just real estate in general, but I've seen and helped process tens of thousands of real estate related investments, other investments through self-directed IRAs. So there's not an investment strategy on this planet when it comes to self-directed IRAs that I haven't seen and properly processed or helped clients through, dozens of times, maybe even hundreds of times. So again, just giving you guys a little background about where my knowledge base is. So why is it so important to talk about retirement accounts? Whether you've got a big or small retirement account, I think it's important to identify that retirement accounts are the largest source of Americans' wealth. More money sits and resides in people's 401ks or IRAs than in their bank accounts. Okay. Now there's a couple of different reasons I want to mention that. That's important. A, you might have an IRA or 401k from an old job or old employer, and that's where most of your investment capital is. But also with self-directed IRAs, something that's always something that you want to keep in the back of your head is that if you're a real estate investor and you're looking for private capital to help fund more of your own personal real estate deals you're buying as yourself or through your LLC, that there's $35 trillion in retirement accounts. And provided the retirement accounts you find are self-directed accounts, like the ones we have at Directed IRA, you can network with people that have self-directed IRAs who might want to loan you money out of their IRA to buy real estate. That's actually what I do as an investor. I loan my money to real estate investors, and my IRA just works like a bank. I get interest payments back to my IRA. Those interest payments are completely tax-free. But my note investment, my loan to the real estate investor, is secured by collateral. So even though it's a paper investment like a stock, stocks don't give collateral. If you invest in the wrong company and that company goes bankrupt, you don't have anything, right? The company doesn't send you anything when they go bankrupt. You just lose all your money. But when I invest in notes secured by real estate, which is just one of the many things you can do, I've got interest payments coming in, but I have collateral, which is the house. I don't want the house, but it's a good, safe investment for me in my retirement account. And I'm doing it because I understand how loans work. So understanding that the largest bucket of wealth is in retirement accounts can not only help you grow your own retirement account, but help you grow other people's retirement accounts as a private capital source for you to buy more real estate. So let's just go back to the basics and talk about what legally are you allowed to own in an IRA or a 401k. Okay. So here's just some of the most common investment options we see, and we'll kind of categorize them as traditional investments and alternative investments. When you look at the IRS tax code, the IRS does not tell us what we're allowed to invest in. They only tell us what we're not allowed to invest in. The list is really short. It's only 2 investments you cannot own in an IRA or 401k. Life insurance contracts and collectibles. That's it. Those are the only 2 things the IRS says you're not allowed to own these 2 things in an IRA. So that leaves a lot of investments out on the table that you can own in an IRA. If you want to buy stocks and bonds, that's when you typically will use an IRA or 401k at Fidelity, right? Because they sell those investments. Those are considered traditional investments. But if you ask your wealth advisor at Fidelity or Charles Schwab, hey, I want to buy real estate in my IRA, they're going to tell you, no, you can't do that. So a lot of people think, oh, you can't buy real estate in an IRA. No, you can't buy real estate in a Fidelity IRA because they don't sell real estate. But if you have an IRA with a company like Directed IRA, we'll exchange your assets of cash for an asset of real estate, just like Fidelity exchanges assets of cash for an asset of stock. It's no different. We process investments the same. The only difference is real estate has a lot of more moving parts, right? You got to deal with a closing, you got to deal with real estate agents, you got to deal with insurance and property taxes. Those are all things that we're equipped to deal with at Directed IRA. And we're never giving you the money out of your IRA to go run and buy real estate. That's another misconception with self-directed IRAs, that we're creating this taxable event because we're distributing money out of the IRA so you go buy real estate. If we did it that way, that would create taxation to you by taking money out of your account. That's not what we're doing at all, though. How it works is you're going to find the investment. You find the property, it's got an address, and you're going to even negotiate the terms on that on that deal. But on the purchase contract, and I'll explain a little bit more in detail how it works when we get to the case study, on the purchase contract is going to show the buyer as your IRA. And we're going to sign the purchase contract as your IRA custodian. We're going to send the money out of the IRA straight to the title company. So you're quarterbacking the deals that are done inside of your directed IRA account, but it's still managed and held within a custodian, with a custodian like directed IRA. So it's not treated as a distribution. You still get all your tax benefits, and you can invest in all sorts of real estate, whether that's a rental property, a fix and flip, commercial property, multifamily property, private stock, private equity, syndications, promissory notes, and more. So basically, rule of thumb is if you can hold title to something, or you can have a purchase contract to buy something, it can be bought in the name of your IRA or 401k. You just have to find a company that's willing to process and hold that investment in your IRA until you decide to take distributions in retirement. So the next thing I want to talk about is just, so what would be the benefits of owning real estate inside of an IRA? Okay, why would you want to buy real estate versus just buy stocks? Well, the first thing I kind of talked about is real estate's tangible. It's like this desk in front of me, right? I can drive by, I can touch it, I can feel real estate. Okay. If you own a stock in a company, obviously we know the risks involved in that, right? Your stock can go to zero if you invest in the wrong company. But if you own real estate, can your real estate ever go to zero if you own it and you manage it properly? No. Because if you own real estate, what's the worst that can happen? Well, it can burn to the ground, right? There could be fire. Well, what do we have to prevent our loss on that? Homeowners insurance, because insurance companies will insure assets that are tangible, and they'll insure assets like real estate. And even if we missed that part of the class and you forgot to get insurance on your properties, which probably wouldn't happen, well, let's just assume you did. That house burns down to the ground. You've got no recourse, but what do you have underneath the house? Land. And land's about 50% of the value, depending on where you buy property. So there's always a safety net there just because of the fundamental difference in how real estate operates versus a stock. Another reason why you see a lot of clients who don't have to be real estate investors by trade, but they like real estate in their IRA, is just for better diversification. So when you hear diversification, most wealth advisors are going to tell you, yeah, you're well diversified. You've got some high risk mutual funds, some medium risk mutual funds, and some low risk mutual funds. I would say you just got a bunch of mutual funds, and that's all your eggs in one basket because all of your wealth is tied to Wall Street. It's actually interesting to know, and I don't want to bore you guys with too much numbers, but there's so much evidence and articles out there that shows that as the rich get wealthy, they actually move more of their asset diversification into alternatives than stocks. They move away from the stock market the more they build up their accounts. If you guys know what a family office is, family offices are all over the country. They're the ones that manage high net worth portfolios. Even family offices understand that alternative assets like real estate need to make up the majority of their portfolio. Most family offices own between 50 and 60% of their entire portfolio in real estate, or they call them alternative assets. Even they're smart enough to know they don't want all their eggs in one basket and tied to Wall Street. And it's even interesting to know that and this is a study actually done by the IRS. Okay, the IRS was looking at self-directed IRAs. This is back in 2016 when they started this study. Before, self-directed IRAs weren't on the radar very much with the IRS because there were just so few clients using it, they didn't really care too much about it. As more and more clients started learning how they can use self-directed IRAs, then the IRS began asking more questions. Now, what makes these self-directed IRAs so attractive? And in the article, there's an article in Forbes, March of 2020, if you want to look it up. And they said the numbers that they found in there. They found that of all of the retirement accounts currently existing at the time, only about 2% of America's retirement was self-directed and owned alternative assets. So we're talking everybody with a small IRA or even a big IRA. Only 2% were self-directing and owning alternative assets out of everybody. But when they took out and they looked at just the IRAs valued above $5 million, you know how many of those accounts were self-directing? 25%. So when you get higher dollar and more savvy investors, where do they like to put most of their money? In real estate. Okay, 95% of all millionaires are made through real estate. Everybody knows that. So why would you not want to own real estate in an IRA if that's where a lot of the, I guess, the rich and the wealthy are putting their money in it? And now with information and technology, now people can find investments that they couldn't find otherwise. Now it's becoming more and more popular, but diversification is another benefit to self-directed IRAs. The other thing I kind of mentioned is just the tax savings. I would argue if you're not using an IRA or a 401k to invest in some of your investments, you don't have to invest in all of your investments in an IRA because you want to feed yourself first, especially if you're a real estate investor. But if you're doing all of your investments in your name or your LLC's name and you're paying taxes every single year, how fast does your money grow? It doesn't grow very fast, right? Because you got to give 30 or 40% back to Uncle Sam. So you're limited on how much capital you can reinvest. But if you invest in real estate inside of an IRA or inside of a 401k, what happens is you buy and sell real estate inside of an IRA, there's no tax reporting. Okay. There's no tax form that an IRA fills out. Okay. All of the profit can be reinvested into the next deal and to the next deal. You pay no capital gains tax in an IRA, provided you're just taking the money inside the IRA and reinvesting it, that you're not taking money out to yourself. That's when you may have to pay taxes. But if you use the right IRA, and I'll talk a little bit about the IRAs here in a second, there's some IRAs that not only grow tax free, but when you take distributions, the distributions are tax free as well. So I've got a client, well, I'll say that when we talk about the account types, but I've got clients that started with a small $10,000 IRA. They've got a $3 million Roth IRA. They'll never have to worry about paying Uncle Sam a dime in taxes ever again in retirement. And this is how self-directed IRAs can help you down the road. It's also a socially conscious investment. I know this is not political in any way, but what I mean to say by socially conscious is when you get to pick your investment, you can pick where your investment dollars are dispersed. Okay. Now I kind of mentioned, and I'll talk Houston because Houston, we got a common denominator. I used to live in Houston. Okay. I have actually made loans while I was living in Houston to real estate investors in Houston. Why is that different than me investing in a stock or a mutual fund? Well, to me, a stock or a mutual fund is a nameless, faceless investment. And I'm just looking at the account statement to see if my balance went up or down. But my view on my retirement account changed when I got to see what the real estate investors were doing with my money when I loaned money out of my Roth IRA to a real estate investor. Okay. So with my money, first, we close at a title company. I'm secured by the property. I can sleep at night. They pay me above average return, which is great. But also what the real estate investor is doing is they're not only taking my money and buying a property, but they're also rehabbing the property. And who are they putting to work? People in my community, right? They're hiring contractors. They're hiring subcontractors. So with my money out of my retirement account, I'm actually putting people to work through the help of the real estate investor. So they're also putting money back in local businesses because they're getting lumber at local lumber stores. They're getting equipment from so my money's getting redistributed back into my own community. Okay. And when they're done rehabbing that property, they put up the white picket fence and then they sell the American dream to a homeowner looking for a new house. Or they hold it as a rental and put somebody in there that's looking for a nice rental property that's refurbished. And they did that all with my money. So not only do I make above average return, but I'm also doing a social good in my mind by making my community a better place to live and play. Now, what if every person with a retirement account invested that way? Like, how nice would our communities be instead of just investing in some, even an overseas mutual fund? Why not invest right into your own community and still even get better returns? So a self-directed IRA allows you to do all of the above things. But most importantly, if you're going to invest, I always just tell people, just invest in what you know best. If you understand real estate, find out how you can apply your real estate knowledge to help your IRA grow. If you understand stocks, then just keep investing in stocks. That's fine. But I would argue most people understand real estate better than they understand the stock market. It's just an easier concept to understand. But again, it's up to you what you want to invest in. Here's the 7 plans that you can self-direct. Now, I kind of mentioned there's 7 different types of plans. I'm not going to spend too much time talking about the specifics of how these plans work, but just know that there's 7 different plans that you can use to self-direct and buy and sell real estate or do promissory notes, whatever it is that you want to do. We've got personal plans, which include your traditional IRA and your Roth IRA. Those can be self-directed. If you're self-employed, you have additional options for self-direction. You can self-direct a SEP IRA, a simple IRA, or even an individual 401k. individual 401ks are great. You have to be self-employed to have those. And you can even have multiple plans on the menu if you're self-employed. You can have personal plans and you can have an employer plan. You can max out contributions to both plans. You can invest them. A lot of times it makes sense to invest multiple plans because you might need more capital to invest in real estate. It just depends on your strategy. And one thing will mention is when I mention contributions, contributions are not the same as profit. Don't get profit and contribution confused. Contribution is what you take out of your pocket and you add to your IRAs each year. And sometimes you're limited. On the personal plans, you can only put in about $6,500 a year as a contribution, but there's no limit on profit. I can take a $6,000 Roth IRA and make $1 million. The $1 million is profit. The 6,000 is my contribution. And most of the strategies that I teach here, they don't even require additional contributions. They just require a small contribution. Then you leverage a creative real estate strategy and let the strategy increase the value of your IRA, not by you working hard and putting more money in it. That's the old way of thinking. That's the old way of how to retire. But if you want to stop working and have your real estate investments pay for your retirement, find out how to use creative strategies to help leverage your IRA, buy bigger things. And I'm just setting some seeds out there because I'm going to talk about how you can do that when I get to the case study. You can also self-direct these two plans. Most people don't even realize this. Health savings accounts and education savings accounts can also be self-directed. These are not retirement accounts, but they are savings accounts. Okay? HSAs and ESAs can help you pay for today's expenses through your real estate investments, provided you're buying and selling investments with those plans. Okay. Health savings accounts, distributions from health savings accounts can be taken the day you make profit, okay, and can be used to pay for qualified health expenses for you, your spouse, and your dependents with tax-free dollars. So that's things like doctor's visits, copays, acupuncture, eyeglasses, holistic medicines, dental work, eye work, all of that can be paid with tax-free dollars versus paying whatever your insurance doesn't cover, paying it out of your back pocket, which is the worst way you can pay for those types of expenses, because what do you have to do to pay for more health expenses if you're using the money in your back pocket? You got to work more hours to pay more taxes, to pay more expenses. Instead, find out how you can consume more of those goods using less money by just figuring out how to use it with tax-free dollars. The same goes with education. Now, this is not your own education, but this is education for your kids, grandkids, or even great grandkids. ESAs, or some people call it Coverdell Education Savings Accounts. These are accounts that can be self-directed. Okay. I have a client actually in Houston. His name's Alan. He doesn't mind me sharing his information. I won't give you his last name, but his name's Alan. He's an investor in Houston. What he does in his daughter's ESA account. Okay. His daughter's about 9 years old now. She goes to private school. How he pays for that private school is not out of his back pocket because he's in a high income bracket. He sells a lot of real estate. He doesn't want to pay it that way because he has to pay Uncle Sam when he makes more money. Instead, what he does is he finds one property that he can wholesale, but he doesn't put his name as the buyer. He puts his daughter's Coverdell education account as the buyer. He works through us, okay, to send the earnest money to the title company from the ESA. Now, he made a contribution to the ESA prior to doing this, but everything's in the name of his daughter's ESA. Okay, the first deal that he did in his daughter's ESA only took $100 earnest money deposit. So this is all he had to put into the ESA. Buyer on the contract was his daughter's ESA, funded through us. Okay, we sent the $100. He wholesaled the contract for $40,000. Where's the $40,000 go? Back to the education savings account, because that was the buyer and that's who wholesaled it. That $40,000 is never taxed, provided he uses it to pay for tuition, books, computers, iPads. He even pays his home internet bill with tax-free dollars out of the ESA, because home internet bill and all cabling is a qualified education expense. If your mind's blown, think of all the things you're paying for now when it comes to health expenses and education expenses that you could instead be paying with tax-free dollars had you known about these accounts. So it's not just retirement that can be funded through self-directed IRAs. It's your health and your education for your kids and grandkids that can be paid through these self-directed accounts. So, and again, it's just mind-blowing all the things that they don't teach us in school. So this is, luckily I taught it and I love it so much because I like teaching it to you guys. Now you can also partner these accounts together to buy real estate or buy other types of assets. Okay. So what I always just use this slide for is just understand what accounts benefit you, depending on how many kids you got, whether you got health expenses, whatever, and what type of retirement you want to live. And know that you can even partner accounts together on the same investments. When you look at these accounts here, you want to think of them, they have their own individual name because they are their own individual trust. An IRA, an HSA, even an ESA or a 401k, by definition, it's a tax exempt trust. You're just the fiduciary of the trust, which means you put money in it, okay, but it's owned by the IRA. You find investments for that account, but nothing in there is owned by you. Okay, you're just the fiduciary that's responsibility to make it grow. So everything is in the name of those accounts, and you can partner different accounts together. When I do a note actually to a real estate investor, on the promissory note, the lender is my Roth IRA. Okay, there's a vesting that you use. We make sure the vesting is correct when you work through a company like us. But I also have my HSA on there as a partial lender too. It's not multiple notes. It's just a fractionalized note because I want when the borrower pays interest back to directed IRA, I want a portion of that interest payment to go to my HSA and most of it to go to my Roth IRA. Okay, because my HSA money I can use today. I can't use my Roth IRA money until 59 and a half, but my HSA I can use today. I've even done some deals where I have two nieces and I set up Coverdell accounts for them. And I even had deals where I partnered my Roth IRA, my HSA, my ESA for niece one, my ESA for niece two. Because every time a borrower pays interest, I've got profit going to four different accounts. And those different accounts have different benefits and uses of money that I can use either today or tomorrow. Okay, so there's better tax benefits that if you can understand how to start utilizing these accounts, you'll find that you have to give less money to Uncle Sam yearly and over the lifetime of your career. I'm gonna skip this. Okay. So let's talk about some case studies. Okay. And here's some of the common misconceptions I hear. I only have a small IRA. Can I still buy real estate? Or I'm not experienced enough to self-direct. So I'm going to break down these misconceptions and tell you about how you can use leverage in an IRA. And again, I've seen this done multiple times, hundreds of times actually, and done by people that are no smarter than anybody on this work webinar. They just basically took an action plan and decided I'm going to start retiring on my own terms and I'm going to start investing how I want to invest. So the types of leverage you can use when it comes to your self-directed IRA or HSA or ESA investments is you can leverage money, you can leverage time, you can leverage experience. Okay. Money you can leverage from other people's money. There's actually banks that have IRA loans. So let's just say you wanted to use your IRA, you only had, maybe $30,000 in there. I don't know, I'm just making up numbers, and you wanted to buy $100,000 house. There's banks out there that will give your IRA, not you, will give your IRA a loan to help buy that property. But you guys didn't know that. If you want to write these names down, here's some of the I'm not promoting any of the lenders. I'm just telling you what lenders are out there. North American Savings Bank is an IRA lender that gives loans every day to people that have IRAs looking to buy rental property. Their website's nasb.com. Another one is First Western Federal. Their website's myiralender.com. You can also go to local hard money lenders. A lot of hard money lenders will loan money to your IRA because your IRA can borrow money, but it doesn't have credit or income to qualify, but it can qualify with equity by putting just a larger down payment down. Okay, so you can leverage bank financing, I'll say, to help your IRA buy and acquire more property. You can also use creative strategies like buying property with seller financing or buying property subject to, which is the example that I'll give you guys here in a second of how one of my clients bought 5 properties subject to, only used $70,000, really only used $50,000 when it came down to it, but was able to acquire 5 properties with $50,000 by just taking over the mortgage payments of distressed sellers. Okay, that's again, you can use that type of leverage, creative financing inside of an IRA. You can also leverage time. This goes to the point I'll make on this is oftentimes if you're using your IRA, sometimes you have to wait to receive the money tax-free and penalty-free. For instance, with a Roth IRA, okay, you don't want to take money out of the Roth IRA if you don't have to. You don't want to take money out of the Roth IRA until you've had a Roth IRA open for 5 years and you're above the age of 59 and a half. Because once you've had those two criteria met, which might take a little time, okay, you've got tax-free, penalty-free distributions for the rest of your life, meaning Uncle Sam can't touch you. They can't touch your Roth IRA. So if you can build up a Roth IRA to a sizable balance, okay, by the time that you're 59 and a half, you can switch your whole game plan to say, I'm never doing an investment in my name again, a taxpayer. I'm going to do all my investments in my Roth IRA. And then I'll just take tax-free, penalty-free distributions from my Roth to the day I die. Okay. That is the best use of a Roth IRA, especially when you're buying real estate, which has multiple streams of income. It appreciates over time. There's so many benefits to owning real estate in a Roth IRA to plan for that day you start taking tax-free distributions. And my case study will explain that. But then you can also leverage experience. It could be your own experience or the experience of others. I would say with your guys' group, you can leverage the experience of one another to help either locate deals, find deals, money partners on deals. There's a lot of creative ways that you can use other people to help your self-directed IRA grow, which again, it's a lot different than when you're just buying stocks. So let's look at a real deal here. So this is we'll just call this person Paul. Okay. Paul actually is a resident of Texas. I'll tell you that. Paul was one of my not first clients, but very early client. And he had a small rollover IRA from his old corporate job. Okay. Cell phone company that he worked with many years, but he moved on and he started investing in real estate, or he was becoming a real estate investor. Now, the reason that's important is because if you've got a 401k at a job that you're currently working at, I'll always get this question. Someone might have this question right now. Can I self-direct my 401k of the job that I'm working at now? Most of the time, the answer is no. That's not a no from me. That'll be a no from them. Because most of the companies that set you up with like a 401k or a 403b or a TRS or TSP, a lot of times if you're still employed by the company, they won't let you move money out until you leave the job, retire, or die. Obviously, A, B is better than C. Okay. But if you've left the job and you've already had it rolled over to an IRA, that can easily be moved into a self-directed IRA. So Paul had already left the company that he was working with. He had already rolled this money into a Fidelity IRA, but he wanted to move it to a self-directed IRA. So all we had to do was just establish a self-directed IRA and submit a transfer request to Fidelity. The money was over to directed IRA in about 3 to 5 business days. Now, when you roll over a 401k to an IRA, normally that's going to be what's called a traditional IRA. Okay, traditional just means it's pre-tax. It means the big bucket of money you haven't paid Uncle Sam on yet. And most people just kick the taxation down the road until they take distributions. Okay, now distributions work different out of a traditional IRA when you hit 59 and a half. So you could take distributions, but every distribution's taxed like income to you if it's a traditional IRA. Okay. You're also penalized if you take money out too early, but you're always going to pay tax. So as a general concept, if you're going to take a bucket of money this big and grow it to a bucket of money this big, what size bucket would you rather pay taxes on, the small one or the big one? I mean, the small one, obviously. But if you're going into an investment strategy that takes a little bit of money and turns it into a large bucket of wealth using the strategy, then I would say always try to convert to a Roth IRA. Okay. So traditional IRAs, even self-directed traditional IRAs can be converted to Roth IRAs. You're going to pay the taxes when you convert, but you're not going to pay the taxes by the time you retire. Okay? I'm just going to leave that at that. So he wanted to have his investments grow completely tax-free. And what he started doing is for each of the next 5 years, when he set up his self-directed Roth IRA, he just said, I'm just going to try to find one deal every year where my Roth IRA can take over the mortgage payments of somebody in a distressed situation and buy the property subject to. Okay. It's important that your Roth IRA or your IRA investments, even when it comes to real estate, don't have to mirror the investments that you do personally. I would make an argument that if you're going to wholesale or do some real estate options, deals that like make money quick, do those in your name because you need to feed yourself. You got to put food on the table. You got to take care of your family first. But those are good deals to do in your own name. But don't let good deals that pay off in the future pass because you can't make money on it today. If it's a good real estate investment that pays off long term, put it on the shelf and throw it in your Roth IRA. These are oftentimes the investments that beginning investors pass on because it might have little to no equity, properties in foreclosure. They just don't think that they can do anything with it. But those are good investments that might fit in a Roth IRA or a self-directed IRA. So his property profile, my client Paul, he was looking for these types of properties. Properties with little to no equity, now for his Roth IRA, little to no equity, expired MLS listing. So he knew that they wanted to sell, okay, and he knew that there was little to no equity in the property when he contacted the seller. And this is the problem that that homeowner was facing, is that because they had little to no equity, they were even either facing short sales, which I'll tell you, short sales are not the easiest things to process, especially for any real estate agent. Real estate agents don't like to deal with them. Some real estate agents love dealing with them, most don't. But every investor was passing on these too, because they're looking at the mortgage statement and the equity. And this was back in like 2009, 2010, as property values came way down. So people owed more on their house in some cases than what the property was valued at. He was also looking at distressed situations. So owners that had not paid their mortgage payment in X amount of months, they're facing foreclosure. Some of them might not have been paying property taxes, so they're facing foreclosure from the county assessor. Again, they're looking for that little to no equity situation with a distressed seller who's trying to just fix a problem that they can't fix because they might have lost their job or something happened in their life that they cannot fix the mortgage problem. The house isn't the problem, it's the mortgage. He also wanted properties in good areas, right? Where he knew the areas would rent well, rent easier, and these are investments he can put on the shelf. Okay. So if you don't know what subject to is, what the client's doing here is, and again, I'm not giving you investment advice, I'm just giving you a creative way to think about how you can start buying property with little to no, or with little dollars in your IRA. Okay. Subject to is simply a type of transaction when it comes to real estate where the buyer makes an offer to purchase the property subject to the existing mortgage of the financing that's already on that property. Okay, so he's just trying to look to take over the mortgage payments of a client, of the buyer, or the seller that already owns the property. Okay. The buyer is expected to keep the loan current, pay up any past due mortgage payments or past due property taxes to get the property current and out of the state of foreclosure, in exchange that the seller or the owner transfers title over to the new buyer. And in this case, the buyer was going to be the self-directed Roth IRA. Now, some people say, well, why would the client do that? Because the client's facing foreclosure. One of these deals was 2 weeks away from foreclosure. If they don't do a deal, if they don't do something like this that's creative and helps catch up their mortgage payments, get it out of arrears, and pay the payment going forward, what happens to that homeowner? They get foreclosed on. They've got 7 to 10 years of bad credit, and they'll never buy a house again. Okay, at least for another 10 years. So Paul was actually solving these people's problems by saying, hey, look, I'll take care of the mortgage going forward, but you've got to deed the property to me, and we'll go through closing. We'll go through the title company, and we'll have all of this done through escrow. But when the title exchanges to me, I'll make payments to get that loan current, and I'll guarantee you that I'm going to make the payments going forward. Okay, so that's the investment made by the Roth IRA, and this was all done through escrow. Now, there are some cautions with due on sale. Again, I'm not giving you investment advice, just giving you from my experience and what I see with these deals. Remember, you have the responsibility to perform, even though your IRA is the owner. Performing means you got to make sure that you've got enough in that IRA to cover any vacancy, to cover any periods of unforeseen for repairs, property taxes. Make sure you've got at least enough in the IRA to pay for some of those things. But I've seen deals where a client used his Roth IRA to take over a property, and there was almost no money exchange. There might have been like $1,000 or some cash for keys, but there might have been just a situation where the client had no equity in the property or was negative equity, and they just wanted to move on and get another house, but they couldn't sell the property that they were in. So they struck up a deal where he said, I'll take over the mortgage payments going forward. Okay. And I'll give you some cash for keys to walk. So the investment might have been just $1,000, but make sure you've got enough in the IRA, or you can at least make a contribution to the IRA in the event that the property goes unrented for a couple months while you're in transition, so forth and so forth. And here's the other thing people always get confused on is, well, the bank's going to call the due on sale clause. I don't know if you guys understand how banks work, but banks are not calling the due on sale clause if the property has no equity in it. Because banks don't want the headache of a property that's got little to no equity. Because what do they do with it if they take it back in foreclosure? They've got to find realtors to sell it. They get hit with holding costs. They take a bigger dip into the red than the actual homeowner would. So banks do not want homes, especially homes that have no equity. But you should also have a plan B in these cases. Make sure that you can either pay off the existing mortgage in the event the bank calls due. And I'll just tell you this, I've done a couple hundred Of these transactions in IRAs, I've only seen one time at about 300 deals where the bank called the loan due. Okay. And this was a situation where they owned it for 7 years. The bank noticed that there was equity in the property now. So they sent a notice to the owner and said, we noticed that this transferred title 7 years ago, and we're requiring that this loan is paid off today. So what did the client do, or what did the IRA do from that point on? Well, there was equity in the property, so all they did is just refinance. They just went to North American Savings Bank. North American Savings Bank qualified the IRA as a lender. That loan paid off the existing loan, and they continued on with the property and kept it as a rental. Okay, so you can go to a bank that has IRA loans and just refinance the property if you need to. You can bring in a money partner that can help you with these situations. Last resort, you can just sell the property and put the title back in the original homeowner's name and restructure the deal. I've never actually seen that option taking place, but it is an option if you run into a sticky situation where the loan is called due. And again, I've never seen it called due, especially with deals on with little to no equity. Okay, so fast forward in time. So Paul, over the course of 5 years, he bought one property subject to. On each deal, he used less than $15,000 on each property. Okay, you can use even less than that. Just depends on how you structure these deals. But fast forward in time, it's been over 10 years now that since he started this, and each property is owned in his Roth IRA. Each property cash flow. So each month, rent's coming back into his Roth IRA. His Roth IRA is making the mortgage payment through us. We make the mortgage payment. So renters are help paying that note down. Over time, those properties, all of them have been in good areas. They're all appreciating. Okay, so each year the properties go up in value. And what also increases with real estate each year, especially if it's rental property, your rents. So rents go up, which make it easier for him to rent these properties. And actually, what he does is when rents go up, your mortgage payment usually stays the same. Okay, because your tax and insurance might increase a little bit, but the interest payment stays the same because these are fixed rate mortgages. So what he does with the additional net rents is he accelerates the principal pay down with the bank. Do you think the banks are happy? Yeah, the banks are getting their payments, and the banks are seeing on-time payments and paying off this loan, which is all that the banks want to see. And what by the time Paul is 59 and a half, okay, each of these properties will be north of $600,000. Okay, meaning that those 5 properties will be in total tax-free, penalty-free, and own-free and clear by the time he's 59 and a half, a $3 million Roth IRA. Okay, which remember, $3 million Roth IRA is a tax-free, penalty-free bucket of money that you can continue to reinvest and live tax-free off of the distributions for the rest of your life. He started with $70,000 in a traditional IRA, converted that to a Roth IRA, and then started to use creative financing to acquire more property. Subject to is just one thing. He could have used seller financing if the properties were owned free and clear. He could have borrowed money from a bank. He could have done this a million different ways. He could even just wholesale these properties when they had a little bit of equity in it. But basically what he's doing is he's accumulating assets using the existing financing that's on the property. And when he dies, these will also pass on to be tax-free to his kids or his grandkids for another 10 years. Because one of the greatest legacies you can leave someone is not just a big bucket of money, but it's a big bucket of tax-free money. And when you pass away and you've got a large Roth IRA like Paul has here, that Roth IRA converts into what's called an inherited Roth IRA. And inherited Roth IRAs can live for another 10 years tax-free and penalty-free. So his kids will receive tax-free income off these rental properties for 10 years past the day that he dies. So this is how the rich get wealthy, and this is one way that you can do it. Other ways that you can do it, other strategies, I kind of mentioned wholesaling. Okay, you can start with $100 in an IRA and just wholesale contracts to build up a little bit of dollars that you can do a strategy like this. Okay, you don't need hundreds of thousands of dollars. I have a client in Houston. He does real estate options. I don't know if you guys are into real estate options, but he does real estate options in the 3rd Ward in Houston, where he'll have the first right to buy property. He doesn't necessarily always buy property, but he's always looking for situations where he can help homeowners that are, a lot of them are hoarder houses. A lot of them are just like there's no equity in them because the time and effort to take all the junk out of the property is like higher than what the property is actually worth. But he's got some financial friends and some real estate partners, and what he does is he uses his one investment. He used a $10,000 Roth IRA to do a real estate option to a homeowner that needed money to pay their property taxes, and 2 years of just living expenses so that she can find some family to move in with. But it was a hoarder house. It was a trash house. Okay, so he helped her with that situation, but that first right to buy extended out for 2 years. And when that homeowner moved away, he basically had to bulldoze the property down, but he used a financial friend who had a construction company, his Roth IRA that owned the property for $10,000, partnered with a construction company in the area. They ended up having to bulldoze the property, but they did a joint venture between IRA and construction company, where construction company brought in all the equipment and lumber and all that stuff to build 2 townhomes in Third Ward, and they sold those 2 townhomes for, I think, 600, that, or it was more like $400,000 a piece. I know what he netted, because he netted after holding costs and after splitting the equity, or splitting the equity on the sale with the construction company. They split it 50-50. His $10,000 Roth IRA investment netted $297,000 tax free just by structuring that deal. He was just creative in his approach and knew that he can bring in other sources of money and leverage other people's experience to help his small $10,000 Roth IRA grow into something much, much larger. So those are just some examples of what you can do. Wholesaling is an easy one. You can do subject to. And one thing I want to leave this message on is Deion Sanders is actually one of my heroes. I followed Deion Sanders from the day that he was playing football. And this is what quote that he had to his team a couple weeks ago. He said, "You don't have to be great to be consistent, but you have to be consistent to be great." And that reminded me of Paul, because Paul wasn't great, okay, but Paul was consistent. Paul just said, "I'm going to do one deal a year with my $70,000 Roth IRA." And he didn't use all the money on each deal. He just used $10,000 here, $5,000 here, $15,000 here. But he just said, "I'm just going to do one deal a year. I'm not going to hit a bunch of home runs. I'm not going to just be a super aggressive. I'm just going to find one deal a year." So even this quote applies to your retirement account. You don't have to be great to be consistent, but you have to be consistent to be great. So my challenge to everybody is, if you're interested in self-directing or just investing in general, it doesn't have to be self-directed IRAs, just try to do one deal a year. You don't have to hit home runs. Base hits and doubles will score runs too. Just find a way to do one deal a year, and you can be creative when you do those deals, and you can leverage other buckets of money. Okay. So how would you get started? I kind of mentioned this. Well, the first thing, if you want to self-direct, is you open an account. The second is you fund the account. It takes less than 3 to 5 days to get money from, say, Fidelity over to your new self-directed IRA, directed IRA. And then self-directing it, the process to actually buy investments, once we teach you how to, what documents we need to own it in the IRA, takes 24 to 48 hours. So it doesn't take a lot of time. It's just a little bit of learning curve to understand how you use an IRA to buy real estate versus buy stocks. But we're very good at helping you through that process. And it's once you do it once, it's like riding a bike. It's not very hard at all. If you guys have questions, you can not jot down my email address. I think Antonio can share it with you as well. And that link, Antonio, goes to your page. So he put together a page that's really helpful for you guys. If you guys want to go there, you can go directly to there, and there's some information, some education there as well. So I think that's it, Antonio. Sorry, I went a little long there, but I had so much information I wanted to try and share in a short amount of time.
You're good. I know you have to be on another call in 8 minutes, so I'll be quick. I had a question.
Yep.
So I've been
Okay.
doing this 2018. I make loans as well, just like you do. And
Yep.
how do you go about safeguarding during your loan process besides collateral? Like, what else do you do?
So I'm specific on who I loan to. Okay, I loan to operators that have track records. So I stay away from beginning real estate investors usually, because it's just too risky for me. I want somebody that can show me that they've got like 10 properties owned, or a dozen properties owned, because I know in the event that my money is loaned on a deal that goes south, they've at least got enough, that they're making on some of their other deals to make me whole. Okay, not that I've ever had to have that situation, but the other thing is, I'll make sure that I loan in markets that I understand the foreclosure process. Okay, I only loan on investment property. That's another thing. I only loan on investment property. I don't want to loan on a house that somebody's living in, because I don't want to kick anybody out of a house if they don't pay me. But an investment property, I can take over the investment property and even keep it rented to the renters in there. But and then I structure the terms where I'm making above average return, and I keep my loans short. 1 to 2 years max on my loans because I'm helping the investor acquire the property. They're not using me for long-term financing, right? They can refinance my loan out and go long-term financing with the bank. That way I get my principal back. But my concept is I want to compound my interest, and I can only do that when I get my principal and interest back and redeploy it on the next deal. So I like short-term loans.
Makes sense. Anybody had one quick question before he has to go? I know I'll tell you, I switched. I was with another company for the past 4.5 years or so. And I switched to you all because you have one set annual fee and it's not based on the account balance. And
Yeah.
as it grows and grows, I don't want to keep paying all those fees. So that's why I
Yeah.
switched.
Yeah,
Matt,
exactly. We just have one account fee. So it doesn't matter if you've got $1 million IRA, it's just the same price as if you got a $10 IRA.
yep. And the podcast, Matt and Mark give a lot of education. So I felt like I owed them I've been listening to them for years.
Yeah, well, and I've got a workshop too. So if you go to our website, there's a learn tab. You can watch the webinars, you can watch the podcast. I also do my own workshops. Like I mentioned, we just did one this morning. My workshops are a little different because it talks more about the strategy. So it gets more into the nuts and bolts and say, here's strategy, similar to what I did here, but here's the strategic approach and how you can do it. And here's what actual investors are doing. And most of all my presentations have actual case studies from clients.
Okay. Aaliyah, he has time for one question. Go ahead.
Yeah.
How do you combine this with a whole life insurance policy?
So whole life insurance is a whole separate thing. I would say you can do both. So you can't own whole life insurance inside of an IRA, but whole life insurance is another way that people create tax-free income for themselves. But you can do that separate of an IRA. I would say if you like whole life, that's fine. I have clients who do both, right? They've got a whole life strategy where they've got some of their money parked there, but they've also got a real estate profile, or actually the investor I'm thinking of, he's got a note profile that he uses in a self-directed Roth. So you can't do them together, but you can do them separate. And I think I'm fine with either of those approaches because it's both it's tax-free income at the end of the day.
Hey, Nate, can you put the screen back on real quick with the contact information?
Yep. Let me do that. Sorry.
No, Tracy just asked for it.
Thank you. Can you see it there? Yeah.
Yeah, thank you.
Yep. And then let me get it back. Sorry. Right here.
Yeah, that one. Thanks. This was great.
Definitely.
Well, thank you. Again, you guys can go to the website, find more information. If you want to just email me and schedule a call too. If you go on the website, you can actually schedule a call with me if you want to talk more about your specific situation. Just go to there's a tab at the top of the page that says book a call. Go down to the bottom, you'll see my name there. So anybody that wants to talk a little bit more, I'm open.
Cool. We appreciate you. If I know you got to go, look, I'll stay on for 5 more minutes if anybody else had any other questions about it.
Thank you guys. I really appreciate your time. Sorry I got to go, but I got one back to back, but I really appreciate it. I had a lot of fun, guys.
That was amazing, Nate. I really appreciate you, man. That was great. Great information. I took about 100 notes. So I'm going to watch this about 3-4 times. Thank you, man.
No problem. Thank you, guys. Have a good rest of your day.
Take it easy. Aaliyah, you had another question? Oh, that's your hand still raised.
So someone had asked about how does this compare with like the whole life? And I just wanted to put out there, we're going to have somebody come in and talk about that. Actually, it's going to be IULs, Index Universal Life Policies. And I've been trying to figure out, even though I have self-directed, trying to do like a comparison. I don't think it's really just another option. You put money into these accounts and borrow the money, interest-free, borrow your own money, interest-free, take it out, put it back, and use it for, real estate or whatever you want to use it for. And it builds interest-wise. It builds interest even while the money is out of it. So we're going to have somebody come in and talk about that. This was good. I wish we would have had a back-to-back, but it didn't work out like that.
Yeah, that'd have been cool. It's all good. Let's see. We got Ryan. What's up, man?
He had mentioned in the call the fact that if you have to take money from, like, if you left the job, so how would you take it if you're currently with the job? Can you take like a certain percentage of your money out with Fidelity to start this, or you just have to use your own after-tax money?
So you can, so whenever it's with an employer, you can't take it. So that's specific for that employer. You have to keep it there. But you could start just a regular IRA, either traditional or Roth, outside of your employer sponsor plan. So what I did was I had a Roth IRA that was with Vanguard. And after years of doing contributions and investing in, I don't even know what I invested in at the time, I just went ahead. This was 2018. I took that money from Vanguard and my Roth IRA and I rolled it over to a self-directed IRA. And then I started doing loans with it. So when I started out, I had like $43,000, something like that. And then I just started making a bunch of loans, and I was doing short-term loans so I can continue to quickly, you know, the velocity of money, basically keep putting the money out to earn interest. And so what I did is just loan to investors, people who, you know, real estate investors specifically. But I've loaned to other people, like a guy that fixes cars for a living, a guy that owns a bar. And right now, all of my money are tied up in Houston on a new construction development project. But usually I just try to do short-term loans, but that's been a long one, actually. But he's paying me 20%. So I'm okay with, you know, waiting a little bit longer. Plus fees.
Okay, so you'd have to start with your after-tax money to start an IRA and then take it from that to the self-directed.
Correct. Yep. You can just start with contributions. So 6,500 is the most you can do for 2023. Unless you over 50, then you can do 7,500.
Okay. Thank you.
Yep. And that's another. All right. One more thing. I don't even do, like, at this point, I haven't put money into it, like contributions wise, since like 2017. So I just let my money, all the interest I keep earning, I just let that, you know, keep building, and I put it out for work and I keep lending it out. What's up, Leah?
What is it in regards to combining the self-directed IRA with like FHA loans, and then also the second part of that is commercial? I'm done with my question, but just buying a multifamily with an FHA using a self-directed IRA, and then also how would you use a self-directed IRA for buying commercial property?
So comment about the FHA thing. These are, you know how you talked about getting a loan from the certain banks? They have to be non-recourse loans for a trust. They have to be non-recourse loans, and you're probably not going to get a FHA loan as a non-recourse loan.
Correct. Non-recourse meaning they can't come back after, like they can't, if you default on a loan, they have no recourse. They can't come to you, the individual, and they can't come to your IRA. But they just have to take the loss at that point. That's what non-recourse means.
Right. Yeah.
What do you think, Aaliyah?
Thank you.
Oh,
and
so
the down payment is high also. It's about well, when I got mine, it was 65%. And I think he mentioned it also, the down payment is higher than norm.
And also you can't make a loan on a property. I'm sorry, you can't enjoy whatever the property is you're talking about buying, you can't enjoy it personally. Like it have to be for investment purposes only. You can't live in it, you can't rent it, you can't rent it to your spouse, your ancestors, or children. So strictly investments. But you can lend to cousins. You can, you know, it don't talk about cousins in the rules. It just talks about like grandparents, grandmother, grandfather, spouse, and then like kids. So ancestral and linear up and down, and then your spouse. So, yep. But yeah, it's a cool little way. It's just a nice way to do something different. I just did it because I didn't want to have all my, like 100% of my retirement funds in the stock market. I wanted to do something a little bit different and just to diversify a little bit. Then I started doing it and I started liking it and I saw the returns and I was like, I could do this. And the reason I started doing loans because I was a bank examiner in my former life for 14 and a half years. I worked as a bank examiner. So I understand loans and how it works. And I just like to be creative and think outside of the box with the loan stuff. But what he was saying is true though. Like there's so many things you can do with this. There's a podcast if you want to search for it. It's called hold on, let me tell you. I don't want to tell you the wrong name. But on the podcast is the people who own that company that he works for. And they have they give all kind of stuff, all kind of information. That's why I switched to the company, because I felt like I was getting so much. And then one of the guys, it's called the Directed IRA podcast. Looks like this. Two guys on the front. And one of the guys, he wrote the book on this stuff. Man, I think on their website, they give you the book for free, actually. Let me look. Hold on. And that's just FYI. That is my referral link, my affiliate link, full disclosure. Yeah, here you go right here. This book right here, a wealth of information. Like anything you could think of on self-directed IRAs is in this book. Great book. Great book. So check it out. Him right here, he's the author. Cool. Any other questions, anybody?
What is your affiliate link for? Oh, I got it. Okay,
Directed
that's
IRA.
that's to okay, to set up an account with them.
Yep.
Okay.
Directed.
Yeah, I'm thinking about moving. Not getting enough support.
Yeah, that's what I like about them. They always have education, always.
Yeah, that's good. Because you
One
need to know
annual
how to use it. You need to know how to build that wealth. So
Yep.
that's good.
Just one set annual fee as well. So I want to say it's like $395 a year, no matter the account size. With my other company, I was paying close to $600 a year.
Yeah. I pay about 150, but it doesn't sound like they do as much.
Oh. Amanda asked me, can we open up one of these accounts for a minor? You can open up the education account for a minor. But as far as the other, like, oh, let me say this. So, and you should consult with your, CPA, tax people, whoever. But like my kids, I pay my kids. They on salary for the company. My kids, both of them, they pay their own life insurance policies, their IUL policies. They also pay their own custodial accounts and their Roth IRAs. So what I could do, and I didn't think about this until you just asked that question, but what I could do instead of me just buying, because right now with the Roth IRAs, I just invest in Apple, Microsoft, and Amazon. That's it for their accounts. What I could do is change it to a self-directed IRA, but that will require a little more work. Whereas I just want to be passive, just invest in those stocks that I think are going to be there when they get older. They're 2 and 5. So when they get around 18 or whatever, and I could transition it off to them to start managing for the most part. But I didn't think about transitioning that over to a self-directed, but I guess that's something I could think about later. But right now, it's just investing in stocks. Is it a person? Huh?
Or even when they get a bit older, AC, and you can kind of teach them, then you can kind of let them, go to self-directed and learn themselves, right?
Yep, that's a good point. John asks, is it per person if you have employees, the fee? So which one are you talking about specifically? Let me real quick. What fee? The annual fee?
Yes, I was referring to if you have employees, just if, because we have 401k, right, and then we have our custodial fee, right. But if for employees, if we switched over to, let's say, self IRA, this type of program, is the fee structure the same?
Now that I'm not sure. You have to talk to somebody over there. I'm not sure.
Okay.
First, I thought you was talking about like a solo 401k, which you can do that as well if you're self-employed and you're the only employee of the company.
Gotcha.
Or you have family members like your spouse and kids that's employees that's still considered one. That's how I do mine. I have a solo 401k as well. And my wife on payroll and both of my kids on payroll.
Got it. Yeah, we have employees, and so we have a certain account we have to do in that threshold. So I didn't know if we could do that, and how would that affect everyone else? Because I could open my own one, like you mentioned, with a separate account. But if I want to benefit, tax benefit, and a fiduciary benefit, for everybody else, I just want to know how that works. If I do transfer. So
the only thing I can think of when you're saying that is if you have employees, like they may not want to do this though. Because then they may just want to invest in, index fund and let it ride instead of having to be more hands-on,
I mean, to be honest, man, not really, because we don't have a lot of participants. And I'm like one of the major people as far as who contribute to the fund. So I have to kind of, long story, but I kind of get that tax back because you got to have a lot of people to contribute to 401k. If not, you kind of get almost penalized, if you will. So it's like you got to incentivize, but I benefit mostly from the fund.
Gotcha. Okay. Well, yeah, you're gonna have to ask them that question, and I'm not sure.
Definitely appreciate it.